I'm Matthew Wragg, CEO of Gattaca. Thank you to everyone for joining the call today. Thanks for taking the time. Highlights for the year. Clearly, the sector and a lot of sectors have been subdued and a little bit tough, and ours certainly has been that. I think from a revenue point of view, slightly up. Group NFI down 5% to just over 40 million. Really pleasingly, this time last year, we said that one of our main strategic goals was to focus on contract growth. I'm really pleased to see a 3% growth year on year in contract NFI, but an 8% increase since the turn of the calendar year, which is first time we've organically been able to grow the contract book for almost 8 years, I believe. So good that our focus on that is starting to pay off. A stellar year from our 10-year overnight success of Gattaca projects, a true statement of work, deliverable business, which had some excellent results, 35%. Not necessarily market driven, that's more the maturing of its customer relationships and capability and investment into our core permanent headcount. So good to see that continuing to grow. And two of our biggest sectors, defence and infrastructure, showing good growth on a like-for-like basis that last year as well. Our split between contract, statement of work and perm has swung more in favour of contract as per design. We have, though, like every other staff, have been negatively impacted by the lack of confidence and movement in the permanent marketplace. So it's sped up us reaching our longer term goals of shape between contract and perm. We have hit that early, not by design, but more from perm being really tough. And that was back 33% in a year. That's actually about 23% like for like. There was a program a couple of years ago that we exited, which had some residual value into the previous financial year. And 23% decline on perm is certainly in line, if not marginally better than our peer group. So some pleasing results in a very tough market. That's all come through to us having a 2.9 million PBT, marginally ahead of our expectations set at half year. So pleased to have delivered again on what we said we're going to do. Good, strong cash position still, which, considering we had a dividend payout and we've been growing the contractor book, is pleasing to see that is still good, and clearly is a very large percentage of our current market cap, which is a point in itself. And good, and we'll touch on it in a moment, good progress on our 4 strategic pillars. I think if I was to summarise a year, we've done what we said we were going to do, and I want us to continue doing that year after year as a business. As we continue to focus on the right sectors and the right territories, that's also seen us exit the US operation. So we still service and sell into the US, but we're doing it from Canada and the UK, but we've exited our US operation. Again, a big part of making sure we are super focused on markets where we feel we can really be or remain that number one player. So we've exited that this year. If we go on to the key initiatives, I really love the fact that external focus is now right at the front of this, and that of these 4 pillars, which has served us well over the last couple of years, that one was the last one for us to be able to get to naturally. But we're really now starting to see the benefits of it. We've invested and built a central business development function this year, which has seen us both convert more opportunities with a better win rate, but also build a better pipeline. But we've also invested more in the training and development of our whole sales force as we continue to build and rebuild corporate memory and be a fantastic place to be. It enables us to get better at what we do, and business development is a key part of that. Alongside growing contract, one of our other statements this time last year was that we really wanted to invest in and scale into the energy market. So really pleased to see that within the financial year last year, we managed to more than double the size of our sales capability, and that, in fact, that now is almost triple the size of where we were. And that's really great to see. I think we'll come on to NFI later. We didn't see the NFI generation of that in the prior year, because naturally from planning it to hiring it to onboarding to then having a team delivering, really the benefits only started and the productivity only really started towards the tail end of the last financial year. But we're really excited as to where that's now going, and got a great team in place. Clearly winning and retaining business is critical, and we've managed to do that, and that's a different message to what we were setting to a bit years ago So pleasing that we're doing that, but we're also getting enhanced and better customer experience and have a really good NPS from both clients and candidates, and continue to look to make be a competitive advantage to them, but also make it easier to work with us. So that's been great. In culture, something I always obsess about, and it was our number one when we started, but really lovely to get some external recognition. We had a couple of awards for culture last financial year. I think there's a real sense of we're doing something, I think, really quite special at the moment. I think we've got a really fantastic business. We've got really amazing people in there. Everybody is super engaged, and that's a really fantastic base and a privilege for someone in my position to have. Our engagement scores continue to improve, and in fact, compared to baseline comparators, which are actually have been declining with challenging market sentiments across various sectors in the last year, we've been continuing to increase, which for me is a really positive sign. And our attrition has continued to reduce. We're at now good, healthy, better than long-term plans. Part of that, I'm sure, I'm not naive enough to think part of that will be the fact that the market's a bit tougher and there is generally less movement of people. But I think even with the attrition we have had, it's been very much us driving standards and performance expectations in our business and focus on the right sectors. So we're in a good place from a culture point of view, and we will not lose sight of that. Operational performance, as mentioned, we've exited the US operation. Really pleased to see the average NFI per head increasing. I think we've been talking about this for a couple of years. We're now starting to see the results of all the efforts we're putting in place to make our consultants as successful as they possibly can be. And that's a combination of standards, environment, leadership, technology, focus, all of these bits coming together to help everybody be as successful as they can be. So that's really good to see. I think we've had the technology investment we made a number of years ago. We've now bolted on a few extra products which enable us to give an even better customer experience. But we've also deployed a large number of automations, which again, just helping us to engage with candidates better, approach clients better, making it easier for our consultants. So pleased to see the direction and excited to see the direction for that for the business over the next year. It's really about capitalization on those platforms rather than any major change. And we also had a reset structurally in the business during the year, partly forced upon us by a sad loss of a great colleague. But we have reset the business in April at leadership structure, and I think it's been I'm very pleased with how that new structure has landed and how everybody's operating together. And I think we've got an exciting future ahead for everybody. From a cost rebalancing, we've been working on this a lot over 2 years. Again, we've right-sized the property portfolio. A major chunk of that this year was right at the back end of the last financial year, so we did get some benefit, but that will also flow into the year that we're in now. A bit like the leadership structure, which we've reset. We've also right-sized and slimmed down the board during the financial year, and that is working really well. I'm really happy with that. And a kind of major making things easier for us to operate. We've shifted to a single bill entity this year, which has really reduced the complexity in the business. Again, just helping us be easier to work with, easier to work in, and a good side of us getting our house in order. So that's been some really good positives for us during the year. From a sector point of view, and this comes with somewhat of a caveat in that we have a budget next week and a US election the week after. So I'm sure we're all eager to know what the outcome of that. But from a sectoral point of view, the markets we focus on are fundamental markets to growth, and there will be opportunity in them. But if you take defence as the first one, it's a market we're very, very strong in. For sure, the new government going for a defence review has just created, probably for the first time in a good number of years, a slight slowdown in the defence market. This won't be a long-term one. Unfortunately, the macro environment at the moment dictates that this is going to be a sector which requires continued government investment. But there is a process going through of which part of the defence marketplace are going to get funding. So that has just created a slight slowdown in the defence sector. But I'm sure as soon as the defence review is done, that will pick back up on pretty quickly. And I was pleased to see that, and nearly all of our sectors actually named within the STEM skills agenda from the government a couple of weeks back as well. From an infrastructure point of view, we're really well positioned, similar to defence. There is a lot of work. There's been some less than subtle hints from Louis Tay around the HS2 going into Euston. What do we do about the Northern Line aspect of it? So I think from a rail, highways and water, these are sectors where the government will need to invest in some way, whether it's directly or whether it's more private, but there will be, and there are major programs. These are also sectors that have economic funding cycles that bridge Parliament. So we're right at the beginning of that in both rail and water, and really it's about bedding in and us being right at the front and focus on these markets. There are always clients winning opportunities. It's about us being really well informed on who they are and being well positioned to service that. The energy market, clearly it's one I've spoken about already as far as significant investment of scale. There's a absolute essential need to continue investment into that. There's lots of subsectors within it, and it's making sure that we grow out. And this is more, I suppose, our focus here is about our own, not self-help, but self-controlled growth, establishing the teams that we've hired in, scaling again as soon as we see the opportunity to do so in a market which has got a huge amount of demand and a lack of STEM skill supplies. So exciting space to be in. Mobility, aerospace, auto, marine has a variety of dynamics going on that. The aerospace market, flights are now back up to pre-COVID level. Airframe orders are huge. The supply chain's been impacted and pressurized on that, which can create opportunity. And in the maritime space, a lot of NATO organizations or countries, are looking at naval fleets and some of the macro environments dictating that. So ongoing needs within that. TMT or technology has been the sector which has been for all staffers and across most of the press, one of the hardest hit skill sets and marketplaces globally. We've certainly felt that as well. But I'm sure with clarity from budgets and elections, investments will start to come. And again, we're well positioned on that. Fundamentally, all of those are underpinned by STEM skills. And this government, and I'm sure the next government and the government after that, will all be looking at how do we as a country and all of the countries that we serve look to continue to invest in the capability of that. If we skip on to labour trends, I think really the most important bit to highlight here is the graph on the right and the downturn on the right, which pretty much started the day you and I took on roles. But there has been a drop in demand, both perm and contract. This is the KPMG RAC report. It's not the deepest drop, but it is by far the longest drop and the longest since they've been tracking it since '97. It has just created a subduedness in the market. It's reduced client confidence to want to be looking. It's increased candidate confidence to be looking. For client, it's probably increased the time and the process of hiring, which is why most staffers have had a tricky time on perm. And as I said, we've not been immune to that. The deeper dive into our own stats on the next slide. This first graph, it shows the contract demand versus our contract fulfillment. So the teal line being the demand, the coral line being the placement. I suppose my point there really being, yes, we have seen a slight slowdown in demand, but we have seen an increase in our capability to convert that. And for me, that comes back to we as a business getting better and better each week consultants being afforded the time to crack on and do their job rather than major internal programs, being super focused on the sectors and the customers and the skill sets that we want to be supporting so that we become better and better at that. So I'm pleased to see that. And then the green and red or lack of boxes on the line at the bottom are the month on month where we grew our contractor book, or whether it declined slightly or whether it stayed flat. So 8 of 14 we've managed to grow, and that's continued into the Q1 of this new financial year. And really the times when it went back are seasonal times when we expect to have a number of finishes over a financial year end or periods like that. So all in all, on a contract point of view, our capability has been building and our confidence in building. Yeah, it's I think the point here is it's not getting worse now. Our flow in of vacancies versus conversion has been a bit more aligned, but certainly on perm, our Q4 was better than our Q3, and our Q1 looks to be better than our Q4. So we feel that has bottomed out. It's certainly not flying back up now, but it's certainly not getting worse, which is interesting to see. On the next slide, and I'll just touch upon this again, cognizant we have a budget coming next week and an election the week after, but there was also, a bit like the budget, there was also a very long drawn out press coverage of the possible changes to employment legislation, which have got confirmed recently. I think fundamentally all of the changes that have been put in place do protect workers more, and rightfully so. They're not ones internally that fundamentally change what we do at all. I think from our clients' point of view, there's probably two dynamics to it, in that it will encourage, I think, clients to work closer with a staffing partner so that the attraction and onboarding process is more consistent, and coverage around the working patterns, the probation period is really clearly articulated, etc. And so that's all good stuff. I think what it could also do with the some of the changes is it could encourage clients to consider taking contractors for a period of time and then looking to turn them permanent. So that's something we're just watching to see whether there is a shift in the dynamic as companies settle into the new regulations. But I think some of the extent of what was being talked about in the press versus what has happened in reality means most good businesses should just be able to carry on as normal, and that's great. I think the one which has gone into further consultation, the single worker status, clearly that is far more complex, and one that we and our industry bodies are far more involved in the conversations about, and pleased to see that go into consultation, because that is a complex one to work through. And as I'm handing over to Oliver, I'm pretty sure he's put this one in just to give me a digging, but they didn't go with the right to disconnect, so my early morning messages to Oliver will probably continue. But over to you, Taslik.
Thank you. If we just skip over the NFI slide onto the NFI bridge, and I'll cover the points in there. So NFI in FY24 was down on 23 by 2.1 million. The key driver of that really was perm, and the decline in the perm market, the challenging perm market. We saw that through those sectors that were really impacted. Defence, of that 0.9 million decline, 1.4 million was the impact of that large exited RPL account, which we exited in 23. So we didn't get the benefit of that revenue in 24. That was worth 1.4. So on a underlying or like-for-like basis, the defence sector for us grew in 24. And over in that bar of other within the UK, all those business units with other have a larger perm focus, and as a result were more negatively impacted. I think probably the other final one to draw out is the energy sector. We've talked about our investment in the energy sector during 24. We did see a slowdown in one particular area of energy that really caused that decline, but we're now starting to see the growth and benefit of the investment we made in headcount, and growing that headcount base within energy, as those sales staff that we brought into the energy team in early and mid financial year 24 are now starting to mature, start billing, and start growing the level of contribution they make for the business. So we're feeling positive about the impact they'll have in 25 and 26 as they mature, and we consider going again in the investment sector with further investment. If you move on, Andy, to the next slide, I think within here really it really does highlight the impact of perm. Great to see that contract grew 3%. I think that focus we put on contract 18 months ago has really played through, and obviously you get the continuing benefit of the growth in contractors. We have seen that continue into our Q1 of the new financial year. We've seen a little bit more growth in the contractor base, so we're continuing to really push that and put that as a key priority within the business. The other piece we worked very hard on to get that PBT outcome at 2.9 was the administrative costs and managing our cost base. Obviously challenging in an inflationary environment and challenging to do that, but really pleased with how we've managed to control and keep a good handle on costs to deliver that profit outcome. Move on one more, Andy. I will just go into the detail on the admin costs. I think really here that £1 million decline in admin costs. Our staff cost is a huge part of our business, over about 73/4 of our cost base, and we managed to reduce our sales staff. So that's really sales and operational leadership, which Matt talked about. The restructure we had gave us an all-in saving of £1 million year on year. So our sales headcount declined. I think within that we saw an improving metric in the NFI per sales head and the NFI per total head, which we really put weight on as a measure of productivity and output of those people. And while sales staff cost and headcount is down, we are improving productivity of the sales staff, and we are also keen to balance that with making sure that when the market, particularly the perm market, does start to pick up pace in any recovery, we've got the headcount and the capability to take advantage of that. Any declining commission, that 0.4 million declining commission is just a basic function of the £2 million reduction in NFI. So that just flows, commission flows with NFI. And legal and professional fees, we've got a real focus on advisor costs. I think we had slightly higher than normal base in FY23, but in FY24 we were back to low levels of that. We changed our auditors, again giving us a saving in there. Want to move on to the next one, Andy? And then finally, net cash, small reduction in net cash balance of 0.9 million, but still got a really strong balance sheet, 20.7 million of net cash, and a pretty substantial proportion, almost over 70% of our market cap, as Matt mentioned. Within that decline, I'd probably like to highlight, so we paid dividends in the year, an ordinary and a special that amounted to 1.6 million, and we undertook a share buyback and then also purchase of treasury shares for future LTIP vestings that totaled 0.8 across those two items. Our trade and other receivables is probably the other one just to flag, where growth in the contractor base, and as we continue to grow the contractor base, we would expect to utilise that element of working capital as our trade and other receivables grow as we grow the contractor base. So yes, I would expect that continuing organic growth is our primary expectation for use of cash, and we'd love to grow the contractor base really rapidly and use cash doing that. It's not a problem. DSO in the year was 43 days, flat on the previous year, and really good DSO outcome. I think really good reductions from when Matt and I took over sort of now 2.5 years ago with DSO at 50 days. We've really now stabilised around 43, 45 days, and that's where we'd expect it to continue over the medium term. I'll move on, Andy. I'll now hand over back to Matt.
Yeah, obviously, huge caveat, I suppose, in the outlook as far as there's a lot of clarity provided both sides of the pond over the next couple of weeks. But I suppose the sectors we are servicing and we want to either remain or become the main player in are always all sectors which have great opportunity in. But we are mindful that client and candidate confidence, even after that clarity, may take a while to come back, and certainly that's our view as we are in this financial year, and that it could still be quite subdued. I think we, like most businesses in the UK, are likely to get some increased unbudgeted costs coming through following the budget next week, and that's something that we will have to work our way through. But I think fundamentally, though, for us, it's just about becoming a better and better business. As I've said, we're a really good business with really engaged people, and they're staying with us and being trained and becoming better and better. So we've got a lot of control about making sure that we do improve. But clearly, we are in market sectors which have a level of uncertainty as to investment and processes. I think I'm really pleased with the progress that the business has made. It's when you do sessions like this where you kind of really take a moment in time to look back over that 12-month period. I think we're really focused on really exciting markets where we've got a good position already and we can make that better. I think we've got a fantastic organisation. I think the utilisation of our tech stack and how we could be leveraging that more and more over the months and years to come is super exciting. And we will, and we've got the opportunity to be looking at how we continue to invest to grow during this financial year, and we will be really mindful to make sure we capitalise on this good base that we've got now to be able to build upon that whilst others may not be in that position. So fundamentally, though, for the year, based on some unknowns to come out of next week and the perm market staying subdued, we're expecting to be around about 3 million PBT for the financial year we're in now, and keep looking to improve during that period. So thank you for watching. I'm sure we'll be happy to take any questions.
Let's start with the elephant in the room. So talk a little bit about perm and linking a couple of questions together. You know, the first one was a very forthright, is there any light at the end of the tunnel? And perhaps linking with that, there's no precise answer, but how much do you think within the UK, the wait for our election, now the wait for the budget and the slight economic uncertainty have been a factor in the market not yet recovering?
I think uncertainty always has an impact. If you're running a business in any of our sectors and you're not sure where government financial backing is going to fall, would you really go in? We all need clarity, kind of whatever the game is. We just need to know what it is so we can crack on and make decisions as business leaders. So for sure, it will have created, and that's why the staffing sector's had the longest subdued time that it's ever tracked, is a build up to an election. If anything, perhaps maybe that coming quicker than we all thought is a good thing. We're right at the storm now, aren't we? So we've got a majority government. It's in. We're just waiting for the budget and the plans. Some of the narrative around industrial strategy is positive, i.e. we're going to have one. So maybe we can get on and make some decent decisions which about investments which last more than the Parliament as well. So it absolutely does impact the permanent marketplace. I think the contract market has also been quite flat, but as I said, there's always winners in it. So, but there's if projects are won but not actually started, that just puts financial pressure on organisations, and there is only such a period of time that organisations can keep holding out to begin the work that they've been contracted. So yeah, some clarity I'm sure will help, but and I'm sure the lack of it, and probably as well the amount of press and speculation, both from an employment law and a budget point of view, building up to it, just makes everyone think about everything, doesn't it? So I've certainly never known one like it. But probably also in the last 5-10 years where I've actually really minded. So as a younger lad, you didn't mind as much. There was always more to be cracking up with.
Human nature. And another question, quite clearly, you have to be involved in perm, but the question is, how many of your clients, is it all of them, actually expect you to be providing both contract and perm services?
Yeah, we've arranged the services now, and that's what I love about our organisation. Whether it's a startup looking for their number 2 hire, or whether it's a global blue chip looking for us to run their entire talent program, we've got our understanding of the STEM skill marketplace. We've developed client propositions for everywhere along the journey. So yeah, we have a whole range of customers who utilize every service, and we've got a lot of customers that only utilize one. I think it really depends on their structure. Some of the bigger organizations will either have outsourced to an RPO or have a big in-house talent team, and therefore doesn't want to use an agency for perm, but absolutely will for contract. Others don't have any of that, but also may not be big enough or want the dynamic of contractors. So it really depends on the economic cycle, scale, and positioning of those organizations. A lot of what we do, if you take defense, energy, infrastructure, in particular, and TIPTH, a lot of that work is kind of project-based work. It has a finite amount of time for it, and therefore there's always a need to carry your permanent headcount and then scale up and scale back down with flexible resources. It's one of the things that's made UK PLC really good over the years, is the ability to be able to do that. So yeah, we like any sales business, we'll always be looking at our service maturity and how many of our customers are buying all services from us. And like any business, there's always more we can be doing on that.
And maybe one for you, Oliver, in terms of reducing headcount, working on perm in the current conditions, or reallocating internally, the question is, do you think you have pretty much finished that right sizing in respect of that area, and will then just wait for the conditions to improve before perhaps increasing?
Yes, I think our headcount now, and our expectations for 25, our headcount will be flat to moderate growth, but only in those sectors where we're strategically focused on growth. So particularly Gattaca projects, energy, and parts of infrastructure and defence. Most of, or the majority of that headcount investment will be in contract rather than perm. I think what we've tried to do with the perm business is maintain a headcount that gives us the capability to take advantage of the market when it comes back, by keeping people who are good, solid billers and just maybe aren't achieving at the moment the full capacity of what they can in an up market, but are still net contributors for us.
Okay, thank you. And another broader question on headcount. What proportion is made up of salesmen of the total headcount to non-sales, and do you have a optimal number in mind for that ratio going forward?
Yeah, salespeople in our organisation, we're currently at 71%. That's shifted from 68%. Clearly, that despite us proactively raising standards and right sizing in the business. So I think our percentage, I think we've got certainly future investment will be about more sales headcount. I think we've got a really great support business in our organisation. We've got a great platform, great infrastructure. We know we can cope with more sales headcount without having to pro rata be increasing the size of our support function. So as we continue to get better in each of our sectors, I can see that sales headcount increasing and starting to shift us towards 75-25 sort of split. And once we're there, we'll look to see where we can continue going. Yep,
very good. Quite a few questions around cash, of which you are in the fortunate position of having quite a lot of. I think you've already mentioned in the presentation that organic uses and particularly investing to grow contract is high on the priority list. You also touched on buybacks, which was one original question, but there's also one whether indeed a special dividend might come under consideration later in the in FY25.
Yeah, I think there's lots of ways that we could be looking to make it work for us. As you say, organic growth would be our favourable, and that's if we can be continuing and rapidly growing the contract base, then absolutely lovely to do that. Clearly on AIM markets, there's a fair amount of chat at the moment around IHT, and but yeah, buybacks is we have done that over the last sort of 18 months, and we'll continue to look at it. M&A, we will continue to look at it. So I think there's a range of options to us. I think we're a business at the moment which has got momentum, and really it's how do we make sure that we use that cash to work for us, and they would be the angles that we will focus mainly on, and that is about contract use, M&A, isn't it? And after that, you're looking at buyback and dividends.
Yeah, nice to have the luxury of choice.
It is, yeah. It's this business has been through a lot of change and necessary change over the last number of years, but it's nice to have us back in a point where it's we're able to be considering those options as to how to really continue adding value to all stakeholders.
And you mentioned M&A briefly there, Matt, which another nice lead into the question of the environment there. It's see depressed markets at the moment. Is that a positive or a negative for someone who has cash in the pocket to look at perhaps bringing in organizations as opposed to selective individual hires? And in that context, you have ambitions to be sector leaders where you've chosen to focus, but a lot of the segments are a long way away from being top 5 or even top 10. So will M&A actually be necessary to accelerate taking those leading positions?
Yeah, our number one priority is just continuing with the team we've got and getting better and better. Like that is absolutely our number one focus. But we also have a really clear plan. We know where we want to get to. We know where we want to do that. We know culturally how we want to do that. And if we see good businesses where we feel we can help them and they can help us to go on that journey, we absolutely are and will explore them. We're not sat there going, we must do this, and it's not part of our next year financial performance expectations that it's done. But absolutely, we also won't ignore the opportunity of it. We're a good business that I think would make a good acquirer. I think people would be joining a good team, a well-engaged business with great infrastructure. And there will be some really good businesses out there at the moment who are in very challenging times. And if they can complement and culturally align to who and what we're out, then absolutely we will have conversations. But they will be sensible, small, bolt-on ones rather than massive transformational ones. This group has made it through one of those, and we won't. We don't need to. We don't want to be rushing back to that sort of thing. But if there's some small, sensible bolt-ons with really good people to come and join our really good people in whatever format that looks like, then absolutely we will look at that.
That's very sensible. Just one question back to the Employment Rights Bill, and this requires the crystal ball or your expertise. Do you think there will be changes in any part or any material parts during the consultation stage?
I think there's always opportunity to evolve. I think, like any complex topic, what you often find is probably it's a bit whack-a-mole once you study and really get into the detail to it. I think the ones that have come through are they're sensible. They're ones that are protecting people who currently could be getting abused by bad employers, and fully supportive of that. I think what will be interesting to see this year is whether it shifts customer behaviour around the contracting part. But to be honest with you, the other part of how do we get stuff done in this country, that there is a huge amount of seasonal work, program work, that flexibility is required, and we've got a really well-established workforce up into the 7 figures who are a really good workforce who help projects get completed. So I think there be nuances of improvement for sure, but the crystal ball doesn't have it looking drastically different, just better protection. And why wouldn't any government or any citizen want better protection for workers, as long as it doesn't stifle business growth? And I think for me, though there's been a lot of press building up to it, what we've also seen is government listening and taking on board the views of all parties, which with a majority maybe they didn't have to, but it's pleasing to see that they have listened and made it very relevant.
Yep, echo those sentiments. The closure of the US operations, again, a question about the nature of your clients. Fully recognise the ambition to be a top 5 player in US recruitment is a very challenging one. But in terms of multinational or global businesses, have you noticed any impact in people who are looking for a literally global offering in terms of placement, or is the specialism in the sector a significant protection for you in that?
Yeah, I think geographies, cultures, legislations, there's a lot of complexities to cross-border activities, which make it very difficult for any organization to look for a single supply for everything everywhere. I've not seen one that does do everything everywhere, and I've certainly not seen one which does a lot everywhere and be able to be as competitive in the various local regions. So I don't see that as a bad thing. I think the US operation that we exited, actually the interesting part for me for that was servicing skills and sectors and clients which had zero crossover with our other territories, and what we're continuing to do is sell into the sectors and clients where we already have a strong reputation in some geographies and they need our support in a new territory. So actually, I think what we've done is just really focus around where and to whom we want to be great with. So I don't see it as a negative thing from our customer point of view. There are some markets where we know we are the best person to go to, and we have great consultants for that. And there's some territories where we know we wouldn't be the right supplier, and we happily steer our customers to who we know is great in that market.
Great. Well, that focus is clearly paying off, and that I think is a good point at which to finish. I'd like to thank our audience for their attention and these wide range of interesting questions. You will get a feedback form, which is very helpful for the company if you can fill it out. And of course, our thanks go to Oliver and Matt. Congratulations on the work in a difficult environment, and we wish you all the luck in continuing that progress.
Excellent. Thank you very much, Andy. Thanks for watching, everybody.